This week we are going to be looking at the US oil. And going into the new week, there is an interesting battle developing between what we are seeing technically on the chart and what is happening around the Strait of Hormuz. So let us begin from the daily time frame and see what price is telling us right now. Looking at the chart here, the broader market structure still remains very bullish. After connecting the series of higher lows here formed since the beginning of the year, we can see this ascending trend line that price has continued to respect. Now look at what happened after price tested the recent swing high around 93.5. From this point, buyers gradually lost momentum and price began moving lower. This decline happened as expectations of progress around the Strait of Hormuz reduced some of the geopolitical pressure that had previously supported oil prices. And earlier last week, we saw US oil fell sharply after reports of progress towards an agreement that could eventually improve shipping through the strait. But notice where the decline has brought us to. Price has returned towards the broader ascending trend line, and around the same area we can also see this horizontal structure that price has reacted to several times. We saw the break here in the month of February. Price came back here again at the beginning of July, giving us a good support level. So already we have a confluence developing here. The interesting question here is whether buyers can continue defending the structure, especially because the Hormuz situation itself is still unresolved. Now, Iran said over the weekend that an agreement is in its final stages, but reopening the strait still depends on further conditions being met. Now, let us scale down to the 4 hours time frame. This is where the recent move becomes much clearer. Connecting the series of lower highs and lower lows formed after the testing of the 93.5 high, it reveals a descending channel to work with. So what we are seeing here is a bearish correction developing inside the broader bullish daily structure. Now look at this area closely, especially around the $75 zone. Price has tested it repeatedly, as we can see. Buyers responded from it last week, and when we connect it back to the daily chart, it also lines up with the ascending trend line we identified earlier. This is why the 75 level is going to be serving as my key level for the coming week. Besides being a psychological number, we have horizontal support, repeated price reaction, and broader daily trend line all meeting around the same area. And as long as this confluence continues to hold, the broader bullish structure remains intact. But a breakdown and retest below 75 would weaken that structure and suggest that this correction may be developing into something deeper. Now look above this price zone. The recovery from 75 has brought us towards 78.5, where price is also meeting the upper boundary of the 4 hours descending structure. So a breakout and retest above 78.5 will show us that buyers are beginning to overcome the immediate bearish pressure, which could return attention towards the 93.5. But continued rejection of this area keeps the $75 zone vulnerable. Now let us scale down again to the 1 hour time frame, because this gives us an even clearer yardstick for the coming week. During the final 2 trading days of last week, price became range bound between approximately 76.7 and 78.5, and this range bound structure reveals the indecision currently in the market. Buyers have the unresolved supply risk around Hormuz supporting their argument, while sellers are looking at the possibility that diplomatic progress could eventually restore more commercial shipping through the strait. So neither side has established control, and this week could give the market more information to work with. The EIA releases its new short-term energy outlook on Tuesday, while Wednesday brings the IEA oil market report and the weekly US petroleum inventory data. If those reports reinforce concerns around tight supply or failing inventory, we could see buyers challenge 78.5 again. But if expectations around Hormuz continue improving and the reports ease supply concerns, sellers may continue defending this area and bring 75 back into focus. So for me, 75 is the major structural level for the coming week, while 78.5 tells us whether this recovery is beginning to gain strength or not. Let us see how the week unfolds. Until then, trade safely, manage your risk, and I'll see you again next week.